Hello and welcome to this week's video on trading using price action. This is the third one in the series, so if you haven't watched the others, watch those as well. We've covered so far, first of all, trading using price action to identify the likelihood of a support or a resistance level holding. Then we looked at trading using false breakouts. So if a market breaks through a level, how can we use price action to think, well, actually, this may not be a valid breakout and maybe we should trade against the breakout. So this week I thought we'd wrap things up by using price action to try and get us in a trend. You know, we all have, I'm sure, have heard the phrase, the trend is your friend. We should try and trade with the trends. But even if a market is trending higher, there will be sell-offs against that trend, and they can be used as opportunities to get onto the trend and try and ride the next wave of that trend. With all these things, it's easier said than done. So first of all, let's start off by looking at the theory about how we can use price action to time entries into the trend. And then we'll look at a real example from the last week as to how this may have helped us. Let's take a look at how we might want to use this idea of reading price action to jump on board a trend and figure out when a trend is continued. Just to remind ourselves, you know, traditionally when we talk about trends, we draw a chart that looks something like that. In hindsight, it's always easy to think, okay, we would have been a buyer here and a buyer here and jumped on board that trend. But of course, when we're looking at it in the here and now, it's difficult to know if we're looking at maybe a better entry as to when these corrections against the trend are going to end. So maybe that's where our reading of the shorter term price action within a trend can help. So let's take this example. The market has been trending higher. We might start to draw our trend line underneath here. The market has started coming off and we're thinking, okay, I would like to get into this trend, but I want to try and pick the turning point as closely as possible. If we're looking at an hourly chart, and this might make more sense in a minute when we look at some real examples, you know, we might have candles that are trading down like this on an hourly chart, so the short-term trend is still very much down, but it's within this bigger uptrend, so we're expecting the strength to come back in. So it's all about, I think, looking at a shorter-term time frame and maybe seeing a candle that does something like this, maybe starts to push lower, but then recovers. So it looks like the market has moved down to lower prices. These have been rejected, and the price has started to move back up. And then maybe if we have a candle here that starts to go up, that's our signal to get in. So I think if we're reading price action within the trend, an aggressive trade here would be to be a buyer, for example, at the finish of this candle, with a stop loss underneath that low where the market pushed down but prices came back up. If we're going to have a wider stop loss and we're maybe going for a bigger move in the trend, then maybe our stop goes beyond that previous low. But it's all about watching maybe the shorter term prices within a bigger trend to try and refine our entries. But that's the theory. It's always very easy in theory. I think it's time to have a look at a few real examples. One of the strongest trending markets we've seen in recent months, and even years of course, is US stock markets. So what I'm looking at here, this is the US 30, so the Dow Jones, the Wall Street index. And I'm looking at an hourly chart. And this is for the last week of July, the last week, 10 days of July. So the market had moved from the 21st of July, trading around 21,570, up as high, and this is the 27th of July, so this is Thursday the 27th of July, trading up to 21,780, 90, that sort of area. But of course, the market doesn't move in a straight line. You know, here we've got a range of about 300 points over the period that we're looking at. But along the way, there have been sell-offs, and as this has been an uptrend that's continued and has pushed out to fresh all-time highs, these sell-offs have been buying opportunity. The difficult bit, of course, is maybe knowing where the sell-off is going to end and jumping in. So what I thought I'd focus on here is what's going on this day here. We're going to zoom in a second, but the 27th of July, the market did push higher, but then you can see starts to sell off quite sharply. Let's zoom in on this part of the chart. So we've got a bit more detail now as to what was happening on the 27th of July. These are 15-minute candles that we're looking at. So the market had started off by pushing higher, pushing up towards 21,785. That was the highest it got. But as the day went on, you can see from about 5:30 UK time, the market started to sell off and dropped from this 21,770 area and traded down briefly below 21,700. But look what's happening in the last two 15-minute candles here. The market's pushing lower during the 15-minute time period. In this example here, as low as 21,700 area, but then gets bought back up. In the next 15 minutes, it does push a bit lower again back down to that 21,700 area, but then gets bought back up. So looking at the price action, you could argue that over these 15 minutes, we know the bigger trend is up. We are seeing the buyers come back in. So one aggressive strategy, if you think these two candles are showing buyers coming back in because we're seeing it retreat back off these lows, is to be a buyer in this sort of area with a stop loss somewhere under that most recent low. Let's just see what happened next. So over the next 45 minutes or so, we do see the strength come back in. So the market in the 15-minute period here doesn't push back below that 21,700 area, and we do see the market start to rally. So an entry here with a stop under the lows would have worked so far. Let's jump forward in time again. So we're only moving forward here 15 minutes. The market's pushed down once again. But again, you could view this as a second bite of the cherry, a second chance to buy in. If you believe that we've seen the price move strongly away from 21,700 based on the price action and the trend is going to continue, you have an opportunity here to buy in. The close of this bar was 21,707. Once again, a stop loss maybe below those recent lows. Let's take the chart out and see what happened over the next few hours. So we're looking at now the rest of the session. This is where we started looking at what was happening. This was between sort of 6 and 7 o'clock in the evening UK time. We did see the market recover, pushes back up, so the market rallies about 100 points then off that level and ends up with a very strong close. So there's a way that the price action, and this was just from the last week of July, where the price action did give us a clue that maybe this weakness was going to come to an end and the trend was going to continue. Okay, so that's the theory and a pretty good example using the Dow Jones index from just a few days ago. Clearly, it doesn't work all the time, and even trades where it does work out, it can start off looking like it's maybe not the perfect trade. So I thought the second example we look at a currency pair, and in terms of trend, we look this time at a market that's in a downtrend, so we're using strength as an opportunity to sell into that trend, and an example where maybe we would have needed to be either a little bit patient and even get stopped out on one trade and put another trade on when the price action told us that actually maybe the trend is going to resume. So let's take a look at our dollar yen example. Let's see how this might work in a downtrending market. This is dollar yen, so the dollar against the Japanese yen exchange rate. Looking at this chart, we've got the chart going back to the 5th of July, so most of the month of July. And for much of the month, it's been in a downtrend. So the market's gone from 114.50 as low as the 110.65.80 area down to there. And of course, we've had rallies along the way, but when we're in a downtrend, we're expecting these rallies to run out of steam. And if we're looking at the market here on the 25th of July, it's a similar thing going on. Yes, we're seeing strength. We're seeing a couple of days of strength, but it hasn't really changed that overall trend. So what we'll be looking for here is the price action to tell us that maybe that strength is running out of steam and we want to get short. You know, people might be looking at these previous highs as levels to set their stops past and looking to sell short and looking for the market to move lower again. So let's just zoom into this last bit of the chart and see what the price action tells us. So we're now zoomed in on the 25th of July. It's around about 6, 7 o'clock in the evening. The market is still strong. So dollar yen has rallied over the last couple of days from the 110.65 area. It's rallied about 120 points. But we're expecting it to run out of steam. We've got these old resistances from back there, so we're going to watch the price action to see what it tells us. Let's just step forward a couple of hours. So we can see the market now has run out of momentum. So reading the price action, some people may see this as a sign to sell short, and I think that's a perfectly good signal. So if we're selling short at 118.85, our stop loss may go, a tight stop loss would be above the most recent high. Maybe giving it a bit more room would be above this high, or maybe this high back here. So either way, we've got a stop loss that might range from about 60 points away to around about 20 or 30 points away, depending on which level we're using. Let's step forward and see what happens next. The market then does push higher. So we do get a move that pushes out after this 4 hours of sideways trading, when the market's pushed a little bit higher. But if we add our stop loss above here or here, then we're still in the trade. But the price action here maybe has been cancelled out by the strength we're seeing. Let's just step forward another hour. We get a down candle now. So even though we've had an hour of the market going up, the price action has turned around pretty quickly. So that could lead people to think, okay, this strength is definitely starting to run out of steam. Let's see what happens next. So the market goes sideways now for a few hours, but in the early hours of the next morning, sort of between 7 and 8 o'clock the next morning, the market does start to slide. So another way of reading the price action, the market's tried to push higher, but is now weakening. So if we're not in the trade already, there's another opportunity to get in the trade. Again, looking to sell short here with a stop loss maybe above that most recent high, above these highs back here, or a bit further out above that 112.40 high. Let's walk through the chart again to see where the price actually moved to. The market's had another go at pushing higher again. It's pushed briefly through these old highs. So we're now looking at later in the day on the 26th. But once again, the market's turned round. So our position, the trade, is under a little bit of pressure. But if our stop loss was above here, we've been stopped out, which demonstrates it doesn't work all the time. If our stop loss was above the bigger level, then we're still in the trade, and the market has weakened once again. So maybe there's an opportunity, if we've been stopped out, to jump back in the trade and put a stop loss a bit further away. Eventually, over the next 24 hours, we get the move we were expecting. The market, after this last push higher, sells off for an hour and then moves sharply lower pretty quickly and does trade back towards those previous lows. So I think there's a couple of things we can take from this. First of all, it doesn't work all the time. If we'd have got in here with a very tight stop loss, we'd have been taken out. And secondly, be patient. Markets can take a while to change direction or continue their existing trends. So having maybe a bit of a wider stop loss and not obsessing over every price change in the market is a better way of trading. Often a bit of patience, sitting on our hands, and the market move we're expecting will play out. So there we go. That's using price action to try and time our entry into a downtrend and an uptrend. I think the dollar yen example is a good real world example where it doesn't work all the time like the textbooks would have us believe. But if we persist and we have sensible stops, we can still time our entries into these trends using the price action. So this wraps up a short series of 3 videos on trading using price action. I'm a big fan of this approach to markets. I think the problem is, for plenty of us in the beginning, we end up with so much other stuff on the charts, whether it's moving averages, stochastics, RSIs, Fibonacci retracements, all this stuff, that we end up ignoring the price. And these things have their place, but ultimately it's the action of buyers and sellers and the price moving that makes trends in markets. So I think everything should definitely start with the price. If you haven't watched the other videos on price action, make sure you watch them as part of the series. We'll start wrapping things up now as usual. If you're not subscribed, if you click that button there, you'll get notified when the next video gets uploaded. I'll be back next week with another approach to trading strategy. If you like the video, click the thumbs up below. And if you have any questions about the stuff discussed today, just leave us a message in the comments. But for this week, from me, David Jones, and Trading 212, we'll wrap things up there, and I hope you have a good trading week.